Good morning, and thank you for joining us for this presentation on the small cap valuation discount in the UK. In our meetings with professional advisors, we've frequently been asked for our views on the current market backdrop and the economic backdrop and how that's impacting our portfolio. This year, many factors have affected the market sentiment globally. And in this presentation, we will explore these from a UK equity investor's perspective, particularly focusing on our area of expertise, UK smaller companies. So this is a different format from our usual presentation, which is a portfolio update. And the next one of those is scheduled on Bright Talk for a few weeks' time. But today, Scott and David from our UK smaller companies team will examine the key factors prominent in investors' minds: inflation, recession, interest rates, and putting them in a historical perspective and illustrating their points with some interesting charts and data. They'll then discuss the impact on the UK smaller companies market in general, and then the metrics of our own portfolio. So we hope you find the content useful, and David and Scott will take your questions at the end as usual, so please submit them on the webinar page as they occur to you. And with that, I'll hand over to Scott.
Thank you, Colin. Good morning, everyone. Thanks for joining today's presentation. I thought we'd start with a reminder of why we believe that investing in smaller companies is a winning strategy in the long run. The chart on the slide looks at the total returns from UK large, mid and small cap indices, and this is from 1954. The data is taken from the annual review conducted by Numis in conjunction with Professors Dimson and Marsh at the London Business School. So it goes back for over 65 years now, and it's published each January, seen as a fairly definitive study of the size effects in UK equity markets. And we can see from the chart, annualised total returns for large caps over this long period of time are just over 11%. Mid-cap 13.4 and small cap 14.8. So you get a pretty decent return for investing in UK equities over the long term. But the annual premium you receive for sticking purely with a small cap strategy has been an additional 3.6% per annum over the large cap returns. So something very much worth having. So with small caps, whilst there are many ups and downs along the way, over the long run, you're amply rewarded for the liquidity and the volatility risk that you're taking. And there is a small cap premium to be had if you're willing to stick with it. However, in the short term, there are times where that fortitude can be really tested, and we're currently in one of those periods. And we're now enduring a bear market for small cap strategies. So the chart shows the shorter term returns over the past 12 months for the key Numis indices that I referred to on the previous slide. And we also include the Numis Alternative Markets Index as well. And you can see it's been a very difficult period with mid and small cap indices down by more than 20% over the past year, and AIM faring even worse, falling by over 30%. So we're already in the teeth of a really vicious bear market for mid and small cap investors, albeit coming from an elevated level last year. And by contrast, for the first time in many years, we've seen significant outperformance from larger companies, where positive returns of 4% have been made despite the current bear market. So for once, the UK market overall has looked pretty robust when viewed in a global context, and David will examine some of the differences between these various indices in his slides later. But really, the past year has been pretty good for investors in large UK companies, but really one to forget as we go further down the market cap scale. But we believe that a lot of the pain has already been taken. And those trends are confirmed in the following slide, where we look at the returns for the various IMA unit trust sectors over that same 1 year period. And you can see right at the bottom of the pile, highlighting in red, is the UK smaller company sector, which has really gone from hero to zero very quickly. And at the bottom of the pile, we're joined by the European smaller companies sector and also the UK gilt sector. So it's been a tough market for UK and European assets in general. We've also included on the slide in red the two other main UK equity sectors, UK oil companies and UK equity income. But if we cast our eyes over to the far left-hand side, we can see that it's really only North America and some of the equity income strategies that have managed positive returns for UK investors. But the US returns do include a very major currency gain from the strong US dollar. The underlying US market has actually been very weak, with the S&P down over 17% in 2022 and the Nasdaq down 25%. So overall, it's been a year of really negative returns across the board, with UK smaller companies very much caught in the eye of that overall storm. So what are investors really worried about? The next few pages, we've looked at some of the recent Bank of America Merrill Lynch survey data and tried to get some pointers from that. This is a major survey of global asset managers, which has been going for over 20 years now, and it is published monthly. And you can see from the chart there that the three biggest tail risks are all related to each other. Firstly, high inflation stays higher for longer. And this is a concern which is, if anything, is rising, it's not falling. The second major fear is the ongoing concerns over global recession, and this has been a feature of the survey for quite a few months now. And the third major issue threatening investors is how hawkish central banks will be in increasing interest rates to deal with these inflation threats that we're now seeing. So I'll return to all three of those issues shortly, but it's really notable how they've quickly superseded previous concerns over COVID and Russia-Ukraine. Those have become, less pressing concerns for investors. So it does highlight just how the deteriorating outlook for the global economy is very much the biggest thing that's keeping investors awake at night at the moment. And those concerns manifest themselves in the positioning that global investors have been taking. So we can see from the chart on the left-hand side, there's been a rapid reversal away from risk assets. So the largest positive allocation at the moment relative to history is in cash, shown in blue at the very top of the diagram. And the biggest negative position now is equities, shown in red at the bottom. And within the equities, the Eurozone and emerging markets are the least favoured markets, shown in red. And in the blue part of the equation, defensive assets such as healthcare and utility feature very strongly, whereas cyclical sectors and technology feature in the red. So these readings are almost the polar opposite of where the survey was in the middle of 2021. So it does beg the question whether or not we should be viewing these results as contrary indicators, and that's clearly a temptation. But nevertheless, they demonstrate a really substantial and rapid change in investor sentiment. And this is also shown in the chart on the right-hand side, which tracks optimism about the global economy in the pale blue line, and also the over or underweight positioning in equities in dark blue. And in both cases, the pessimism is already very extreme compared to history, with the recent readings actually exceeding those of the 2008 global financial crisis. So overall, I think we can conclude that the consensus among global investors in general is one of extraordinary levels of pessimism and risk aversion, so very much in bear market territory. So I guess the big question from all of that is how much further do we have to go in this down cycle of markets? And slide 8 attempts to summarise a pretty detailed piece of work done recently by UBS, looking at market returns in a variety of recessionary periods over the past century. So the data covers the US market predominantly, but the broad themes do apply to Europe and to other markets. And overall, UBS identified 17 recessions for the markets in their work. 7 they classify as deep, and those are shown in blue, and those are typically recessions of more 3% declines in growth, more than 3% declines in growth. Those are shown in blue. And the 10 shallow recessions are those where the impacts are less than 3% on growth, and those are shown in orange. And if we look at the deep downturns on the left-hand side, on average, during those periods, the US market fell by 34% over 12 months, just prior to and then including the initial recession. And those events are quite often shocks. They can last for 2 to 3 years, with the most extreme downturn coming in 1929. Interesting to note there was actually a positive response to COVID in 2020, so that was a very short-lived shock. If we turn to the shallow recessions on the orange, the market reactions there tend to be less extreme. The average fall in these periods is 11% over the 12-month period, and those tend to be well-flagged events. The market's typically falling for 8 months ahead of the actual recession in most cases, so much less of a shock factor at play. It's really impossible for us to predict at this stage whether we're facing a short, sharp downturn or a long, protracted one. I think the historic data here shows that we've already taken quite a significant step down this road already. The S&P index, for example, is down around 15% over the past 12 months. So again, quite a lot of negativity priced in as we sit here today. Taking the 3 concerns from the survey that we highlighted a moment ago, firstly, rising interest rates. We've seen dramatic rises in government bond yields from historically very low levels. And as of today, UK gilts are around about 3.2% and US Treasuries up to 3.4%. In Europe, we've seen similar rises from what were previously very negative government bond yields. So these are really seismic shifts in the short term. And the chart on the left just serves to remind us of how extraordinary the last 10 years have been driven by ultra low interest rates, loose monetary policy and quantitative easing everywhere. So essentially, the recent spikes in yields take us back to where we were 10 years ago coming out of the global financial crisis. So perhaps we've returned to the old normal, if you like. But at the moment, markets are really fixated by how high the short-term rates can go. And we all know that they're set to go up further, but to what extent and where will they peak? So the chart on the right-hand side plots the short rates globally that we have at the moment and adds Refinitiv's consensus expectations in the dotted lines. And broadly speaking, they're indicating a peak of 4% in US short rates and 3% in the UK. So with the rate rises that we've already seen and the ones we're now expecting, we could get there pretty quickly. And I guess this week's poor inflation numbers in the US have added fuel to this fire, with some people now expecting rates could go to even to 4.5% in the US. So as with equity markets, we have no real way of knowing how much further this has to go, but we do think we're a fair way down the road already. The other two issues highlighted by the survey were the impacts of high inflation for longer and how this would affect global growth going forward. So fears, therefore, of stagflation are now very real in markets, and we've all been shocked in recent months by the extent of the inflation we're now experiencing. The escalation in energy costs being a really crucial factor since Russia invaded Ukraine back in February. The most recent US inflation number, which spooked the market this week, came in at 8.3%. The UK has just followed with a number of 9.9, and the broader European CPI number is currently around about 9%. So inflation is very much a global issue, with energy costs at the forefront, followed by food and then ultimately wages. And wages are driven by historically low levels of unemployment in the major economies. So I think we can safely assume that 2022 will be a fairly terrible year for inflation. And the Barclays forecasts on the top right-hand side of the chart are suggesting 6.7% global CPI in 2022. I guess the more pressing concern for markets is when and how quickly will these numbers come down. And Barclays' global forecast for 2023 is 3.8, but this does assume fairly major improvements in both the US and the European Union. Interestingly enough, it still has UK inflation remaining stubbornly high at 9.5%. But we hope with the recent energy rescue package announced, that number will start to come down sharply. And hopefully the recent press comments with Goldman Sachs predicting 22% will mark indeed the peak in sentiment for negativity on inflation. But this does leave a fairly feeble growth outlook for developed markets in particular. And if you look at the 23 forecasts on the bottom right, we can see that the US, UK and Europe are all expected to enter recession fairly imminently. And those three regions are forecast to have very low growth in 2023 overall, well below 1%. So long way below the long-term trend. From the UK perspective, there are also some negative forecasts coming in there. The Barclays 0.9, we've seen forecasts which are now minus 0.5 as well. So quite a range of outcomes are possible. And really from the global perspective, it's worth noting that we have an expectation that China will bounce back after a fairly lackluster year in 2022, with growth less than 3% in the current year and predicted to be 5% next year. So that will be a fairly big driver of the overall global number as well. So overall, avoiding stagflation really is a big theme as we move into 2023. I just wanted to complete my section with a quick word on currencies. As we sit here in the UK today, we tend to be very focused on falling sterling. And this weakness here has escalated significantly over the summer. We've seen huge increases in inflation, lots of political uncertainty over the Tory leadership, and a weakening fiscal position. So, it feels like there are dark days ahead of us in the UK, and weak sterling is another reason to be nervous, which could lead to even greater interest rate rises. But it's probably important to note that the currency story really is one of dollar strength rather than just sterling weakness, and that this is shown in the chart on the slide. And over the past 5 years, the pound is down about 13% against the dollar, with most of that coming in 2022 already. The euro and the yen have been even weaker over the 5-year period, as shown in the chart. And even if you go back 10 years to include the Brexit vote in 2016, then sterling has fallen 28%, the euro has fallen 22%, and the poor old Japanese yen is down 46% over 10 years, and now a 40-year low. So really, this has been a story of dollar strength. And at the moment, one of our key stock selection strategies within the portfolio would be to favour UK businesses with plenty of dollar earnings. So that really concludes a quick run through some of the major concerns affecting investors at the moment from a top-down perspective. There are a number of major obstacles to overcome, clearly, but markets already reflect a hugely bearish consensus position. So with that, I'm now going to pass the baton on to David, who's going to examine some of the reasons why we think UK small cap assets look very attractive again.
I think I'll let you all take a very deep breath after that. I think my job this morning is to try and cheer everyone up after what's gone before. And what I'm going to do is drill down into the UK market and what historic performance has looked like in times of stress, such as we're in at the moment. And also I'll highlight where we think current valuations sit in terms of attractiveness. This chart, which shows a split of our benchmark, which is the Numis smaller companies plus AIM, and they all share how the relative performances of those two segments of the market have been over the last 20 plus years on upside and downside. And it's clear from this the beta that you get with small cap, which everyone would expect. That beta is clear in both directions. Broadly, there are some few exceptions, but broadly, small cap participates fully in downside liquidity as well as other reasons, but bounces back very considerably on the upside, and that is what's driving the long-term outperformance of small cap. Clearly, in all of this historical context, that leaves 2022 year to date looking pretty extreme against a fairly neutral to small positive large overall market performance. Clearly, our benchmark has very significantly underperformed. A large part of the explanation of that performance this year, and indeed look back over history, is the very different sector mix that you get between large cap and small cap. These are very different investment universes. This chart shows the sector weightings in the two segments. And if we just focus on the main divergences from left to right, starting with industrials, we see there a 10 percentage point overweight in small cap relative to large cap in industrials. And industrials as a sector classification is a broad church. But fairly substantially within that are business services, so not the sort of heavy manufacturing and industrial names that the overall title would suggest. And our benchmark, our universe, is fairly heavily weighted in business services, support services, those sorts of areas, B2B services. Moving along a bit to consumer discretionary, again we see an overweight in the Numis and AIM. This comprises clearly such consumer areas as hospitality, retail, and leisure, which is larger within the smaller end of the market than it is in large cap. And this sits alongside business services as indicating quite a significant domestic exposure within the small cap universe, and that clearly, that domestic economy exposure clearly has not been helpful in 2022. Information technology is another area worth noting. Again, a 10% weighting differential compared to large cap, which really has very few names, Aviva being the most recent one, which has been the subject of a bid. Here we're talking almost entirely about software companies, and software has been a very difficult place to be again in 2022. Derating caused by rising bond yields, but also the sell-off in the Nasdaq has been transmitted into the performance of this sector. So another headwind to small cap performance. Moving to the extreme right side of this graph, the biggest divergence here we can see is within consumer staples. Now, the large cap index clearly well stocked with global brands within food, drink, and tobacco, and that's simply non-existent within small cap. Those defensive areas have been outperformer, big outperformer in 2022, which has helped the income fund performance that Scott mentioned earlier, but clearly is a headwind rather to small cap performance. And similarly, the other areas that where large cap had outperformed, energy, utilities, healthcare, and banks, small cap doesn't have the same exposure, and that favours large cap. So overall, in 2022, the sector mix has made it a tough environment for small cap. And in a global context, again, all major markets have sold off since 2020, but the UK and Europe, which are the lower two graphs on this chart, have maintained their historic discount to large cap. So fully participated in the global sell-off. And you should note here that these are forward multiples for the UK, the US, and Europe ex UK, which adjust for divergent sector weighting. So the heavy US tech sector weighting is adjusted for. So this is sort of on a like-for-like basis, which shows that the UK remains at a discount. And within that overall UK discount, UK small cap is cheap. So cheapness within cheapness. The left-hand side is a familiar chart we get from Liberum. We used it in previous presentations, and it looks at the 12-month rolling forward PE across the main market segments: large cap, mid cap, and small cap. Now, if you looked at this at one point last year, that forward multiple profile had actually flatlined. So small cap had re-rated, large and mid cap had derated slightly, and you couldn't pick or choose between the forward PEs. We've now seen a return to a more normal top left to bottom right trend line, which has come about as a consequence of the small cap underperformance. The forward multiple on AIM is clearly a bit variable, as it always is. On the right-hand side, how is that reflected in actual numbers for the indices? Well, you can see that small cap has accelerated on a downward path and is now in danger of revisiting the previous lows, historic lows of the dot-com boom bust, the great financial crisis, the GFC, and also the pandemic. So we are revisiting relative lows in terms of small cap forward multiple. So how has all of this affected our own portfolio? Well, again, this is a chart that we've used before, so hopefully some of you are familiar with it. This is using Canaccord Quest data, which allows us to provide an aggregate valuation for our portfolio, and also provides an aggregate valuation for the market, the UK small mid cap SMID market. Now, this is this Quest market data is not the same as our benchmark, which I said before is numerous smaller companies plus AIM, but it's as close as we can get to it, and it's a reasonable proxy for our benchmark. We are growth investors, unashamedly, and so you would expect that the main valuation parameters, PE ratio, EV sales, EV EBITDA, would show a premium to the market as a whole. But what should be drawn out from this, the first column and the third column show the current aggregate valuation of the fund, 31st August. The comparative is about a year ago, 30th September 2021, when we started to really pull this data together. And that shows the really significant degree of compression that we've seen over almost a year in the valuation parameters. Interestingly, although we don't specifically target dividend yields, we like to invest in growing companies that have surplus cash flow and can pay a growing yield. So I think it's fairly significant that as a growth investor, we can show a dividend yield in the portfolio, which is in line with our overall market. Price to book is also worth a bit of explanation. We generally favour low capital intensity businesses which don't require a lot of fixed assets lying around. These are businesses in areas such as software, healthcare, financials, services. And then the lack of need to maintain and improve and reinvest in those fixed assets means that there's additional free cash flow. And as a consequence, free cash flow yield now sits at a sizable premium to the market overall, reflecting the fact that we're investing in growing and cash generative businesses. Cash flow generation is also helped materially by EBIT margin, by high margins, and this is a very consistent picture. The overall EBIT margin of our portfolio constituents is markedly higher than the market overall, and indeed has gone up over the last year. All of which overall means that we have a portfolio of companies which in aggregate have net cash. The net debt EBITDA ratio here is negative relative to a leveraged market overall, and that's a very good position to be in an environment of rising interest rates. We also put our portfolio through style analytics, which I'm sure many of you will know, and that methodology regularly confirms that we have a very meaningful tilt towards quality and growth. Now, having that style analytics benchmark is a useful cross-reference that confirms what we think we've got in the portfolio. But ultimately, the question is, in a down market, how does this ultimate quality get crystallized? Well, here's how. I'm sure you've all noticed that bid activity is pretty rampant. Probably not too strong a word in the UK market at the moment, but actually that activity has been building over several years, and we've seen bid approaches in the portfolio going back over the last 2 years. This is predominantly and primarily reflective of private equity activity. There are some trade buyers around, but whereas in the past PE targeted cash generative but fairly mature businesses where they could financially engineer and sweat some very tired assets, sort of things like hospitality and retail. The focus of private equity now is very much on cash generative growth companies. So they've come knocking on the doors of our portfolio. Now, sadly, whilst this generates a quick boost to public market returns, it is a very major concern that we're seeing a lot of really high quality companies now disappearing into private markets, and shall we say, not quite the same pipeline of new companies coming through necessarily. Of 28 bids in the UK market year to date in total, the portfolio has been involved with 5, with, and the bullet point at the bottom, an average bid premium, average uplift of 47%. There is another approach that's been announced for GB Group. It's only indicative at the moment, and we don't know what price that's going to be, or if it's even going to happen at all. But if that did transpire and you did include it, the portfolio's hit rate in terms of overall bid activity is about 20%. Across the whole of the Amati funds, we've had another 2 bids within the VCT, which would take our overall hit rate across all products to nearly 28%. And we think that this is ultimately the proof positive of our investment approach, where valuation anomalies are actually crystallized by company takeouts. So to sum up, as Scott has already indicated, small cap has consistently outperformed over the longer term, and within that we know that quality has been rewarded. Today we have a well advanced bear market with a heavily negative consensus view, and really whenever extremes exist relative to historic norms, investors really have to ask the question, where could the consensus have got this wrong? Where could actual outcomes contradict expectations? And whilst the overall consensus risks that Scott went through, the macro risks that went through at the start of the presentation, those are all very well known and built in. It would appear that private equity is seeing plenty of opportunities in public markets. And perhaps in that sense, they are following the Buffett maxim of being greedy when others are fearful. And I'll leave you with that thought and pass back to Colin for M&A.
Thank you very much to both David and Scott there for the presentation. And we've now got some questions from the audience. The first one is, how sustainable are the quality factors within the portfolio into a recession? You mentioned the cash flow margins and net cash, etc. Who would like to take that one?
Yeah, I'm happy to take that, Colin. Yeah, I mean, we've done the analysis using the Canaccord Quest database and also cross-checked it with the Style Analytics database. So quite a lot of data crunching to back up the history. And I think, you know, what we found was over the life of the fund, those have been relatively consistent factors, those quality factors. When David highlighted the net cash within the portfolio and the high operating margins. And we think those are really, really vital components, you know, for the times ahead. You know, if the economic forecasts are correct and we go into recession, then those are the types of companies which hopefully will weather the storm. So we do feel that, you know, having those things in place will hopefully, you know, protect the portfolio from some of the worst things that may happen. And indeed, some of those companies will have great opportunities, you know, to expand their businesses in weaker times. So we would expect those factors to remain constant and hopefully, you know, provide some positives for the portfolio. It's not always been the case in the current year. You know, everything has fallen pretty rapidly, but, you know, as time goes by, we do expect some differentiation to come into the market, and hopefully we'll be well placed for that.
It's always the case with.
No, carry on, David.
Apologies, I had myself on mute. It's always the case with smaller companies that you have to question how they maintain their market position, how they maintain price control, price advantage, margin advantage, because they're up against much bigger competitors, probably better resource competitors in terms of finance and management resource, etc. But our focus on companies that have a market edge, have intellectual property, would underpin, we think, that margin visibility. I think if we go into a real outright recession, then all margins will come under pressure. But to the extent we have price makers rather than price takers, then they will fare relatively slightly better.
Thank you. Another question from the audience. How much is survivorship bias a factor in the long-term outperformance of small caps?
I'm conscious of having a lot of echo on my line. Is anyone else getting that? Nope. Okay, it's just in my headset then. I will touch on that. Yeah, the small cap universe is clearly subject to a lot of churn. We see companies sadly disappear. We also see a number of companies get promoted from small cap into mid cap and ultimately into large cap, and we've seen numerous examples of that in our portfolios over the years. So there's a constant refresh of the small cap constituent population, and therefore I think the longer term performance is comparing like with like. It's not that you just looking at the performance of a small number of truly outstanding small cap companies and everything else is the living dead or gone bust. It's a very vibrant community, and that's ultimately why you invest in it. The best investment you can make is in companies that can grow for the longer term.
The only thing I would add to that, Colin, is that obviously survivorship bias is a feature in almost all indices over time. It's certainly more pronounced in small cap than it would be in large cap, but nevertheless, it's a feature, you know, which is ongoing, you know, across the board.
Thank you, Scott. There's another question come through. How much risk is there in your 1 year forward free cash flow yield of 7.5% of your portfolio? How much of the uplift in this is due to sector rotation, to oils, etc., in the portfolio itself?
Yeah, that's a really valid question. I mean, we have made changes to the portfolio over the 12-month period. So the slide that David presented about valuation, clearly the valuation has changed quite a bit. And two things have happened. The markets obviously have come down in an overall sense, but we've also made changes to the portfolio. We have far fewer exposure to loss-making businesses, for example, but we cut back on a number of the early stage businesses towards the end of last year. So that would improve the metrics. And you're also right that we have more exposure to oil and gas than we had a year ago as well. And those are typically companies which are trading on very low valuations. So I think it's a valid point that's been made there. Ultimately, the free cash flow is determined by profitability, so that would be the major factor there. And it's fair to say that all companies by definition have more volatile cash flow than the more steady state businesses. But I think the fact we've got the net cash at the overall portfolio level insulates us from some of the more extreme profit downgrades that we will see.
The arithmetic of that calculation as well is that the cash generative companies that we were already in before making any sector switches have just all got a lot cheaper, and so arithmetically the free cash flow yield has gone up.
Great, thank you very much for that. What is the outlook for ongoing PE bid activity?
I'll maybe touch on that. Everyone's well aware that private equity has the term lots of dry powder. The capital raises that private equity funds have had over the last several years means that they need to put that to work. So there's, in terms of the activity we're currently seeing, there's a combination of highly attractive valuations and a weight of money that needs to be invested. I think the broadening out of private equity targets into sectors out with what they looked at before probably reflects a little bit of risk-adjusted investment in that the old hospitality assets are still probably in a situation of oversupply and structural decline. So they're looking elsewhere for companies that have the attributes that can allow them to do a bit of leverage and profit from companies with good cash flow, and that's taking them into other sectors, other growth sectors, which overlap much more with where we are. I pretty much think that continues, given the amount of spare cash they have. You have to be slightly careful that there must be problems in private equity portfolios dating from old investments in distressed assets, and they will have to put quite a lot of their cash into supporting those going forward. But I think that still leaves plenty of headroom for them to be active in the public market. And as I said when I presented earlier, that's great for bid premiums, but it's less good for the ongoing quality of the UK public market.
Thanks, David. We have another question here I'll put this to Scott. What gives you the confidence that UK small cap can do better than UK large cap? Surely large dividend paying companies are the place to be right now.
Well, I guess that's a true statement at the moment, yes. They have been the right place to be, certainly over the past 12 months. I'd probably go back to the opening slide. We look at the long-term returns from smaller companies versus mid and large. So the evidence is there that there's a substantial premium to be had from small cap, but clearly we do have periods where things go awry, and we're currently in one of those periods. I guess it also goes back to the chart that David presented on the sector splits between large and small, and we take the view, small cap investors, that in the long run you'll get the best returns from the most dynamic growth sectors. And those, to be honest, really aren't apparent in the FTSE 100 and in the large cap. There's virtually no exposure to technology. The healthcare exposure tends to be in very large companies, such as Astra and Glaxo. So really, we would say in the long run, you're not investing in growth in the FTSE 100 or large cap income type strategies. So they'll probably look pretty good for the next 6 to 12 months, but at some point, they'll revert to the mean, and underperform. And that's firmly what we believe, as small cap investors.
Okay, that's great. Thanks very much for that summary, Scott. We have a few more questions come through. However, our time is due to run out in a couple of minutes. So I think we'll get back to those other questions directly to the people that put them. So thank you very much for submitting your questions, and thanks to David and Scott for the presentation. As I mentioned, a full portfolio update is due in a few weeks' time, a month or so's time, so you can register for that on Bright Talk 2. However, if you've any questions arisen from this presentation that you'd like to discuss, please get in touch with one of the sales team shown on the slide just now. However, once again, I'd like to thank you very much for taking the time to join us this morning. And until the next time, goodbye for now.